We have about 11 on. Is that about right?
Yeah, we're good.
Okay. All right, everyone. My name's Janet Davis. I'm with a company called Midland 1031. We have two divisions. One is a self-directed IRA division where people can purchase assets such as real estate with their retirement funds. And then our other division is the one I work in, 1031 exchanges, which we're going to focus on today at a high level. I'm going to go over some of the basic rules and things that will help you all talk to your clients about it. So let's go ahead and get started. I'm going to share my screen. All right, just want to confirm, can everyone see that?
No,
Can't see it?
no, it's not showing yet.
Okay. Let's see, let me try. How about?
Yeah, it's yeah.
Now it's starting to?
Yeah.
There you go.
Okay.
Good, thank you.
All right, how about now? Everyone
Yes.
can see it now?
Yes.
All right. Here we go. We're going to go ahead and get started. Just a little bit about me real quick. I've been in the commercial real estate industry since 1997. So a really long time, done several different jobs. And since 2015, I've solely focused on facilitating 1031 exchanges. One thing about Midland is that we're here to help you. And I think JK Closings can tell you that. We're happy to talk to anybody. If you have any questions, any of your clients, we don't charge any commissions or anything like that for questions. We do believe highly in education. So anytime you just need to reach out or you think you might have a potential 1031 and you just want to run it by me, please feel free to do that. Okay, what's a 1031 exchange? I don't know how much y'all will know, but this will be very basic. So hopefully not too uninteresting. Feel free if you want to unmute yourself and ask me any questions as we go along, that'll be fine. A 1031 applies to business or investment use property only. It is an actual section of the tax code. And what it means is that if someone exchanges an investment property for another investment property, no gain or loss is going to be recognized if they follow certain rules. So we're going to go through that. There's 4 types of exchanges. There's an exchange that occurs when you actually swap properties. That's very rare, but that does exist. The one that happens most of the time is called a delayed 1031 exchange, which means there's timelines that you have to follow, and we'll go through those in detail. There's a exchange called a reverse 1031 exchange, and that's when you buy your property first and then sell, and then also an opportunity to include improvements in a 1031 exchange. We're not going to spend a lot of time on those last two because they are they're more rare and they are more complicated. So we'll spend more time on what's called the delayed exchange, which is what I'd say 95% of the people do. Exchange is going to defer all your capital gains taxes, depreciation recapture tax, usually state taxes in most cases. And then if you're subject to the Healthcare Tax Act or Obamacare tax, then it should defer that also. The only state that does not recognize on a state level the 1031 is Pennsylvania. So just keep that in mind. If you have clients selling in Pennsylvania, they are going to owe a state income tax, but it is recognized nationally throughout the rest of the United States. There's a lot of reasons that people are going to do a 1031 exchange. One of them is because they need greater income potential. So let's say you have a client up north that owns a piece of vacant land, and they want to exchange into properties that actually generate income for them for their retirement, or just to have extra money in the meantime. So a lot of people diversify from land, so they'll sell land and go into different properties that generate income. They also may want to consolidate. Maybe they're tired of being a landlord for multiple rental properties or commercial properties, and so they decide to sell maybe 2, 3, 4 properties and buy one big property where they can have one person manage that and then just collect rents off the one property. They may want to acquire easier to manage property. So maybe they have a thing like a commercial office or a retail center, or maybe some rental condos, and they're tired of being the landlord. So they want to exchange those into vacant land. There are some things that would apply to doing that if they went from real property, like an actual building, into vacant land. That would have to be taken into consideration, but basically they would still defer their capital gains taxes on that type of exchange. Here's one that we run across a lot in Florida. People want to move markets. They own not only their primary residence up north, but also several rental properties or properties they've held for investment. So at this point, maybe they want to get rid of all those, sell all those up there, and come down here and buy stuff in Florida. And that's where it's a real opportunity for you all to take advantage of this particular strategy. If you're helping someone find maybe a second home down here and they're moving from up north, go ahead and make it one of your questions. Hey, do you have rental properties up north that you're trying to sell? And maybe move those down here when you're, living down here 6 months out of the year, or maybe eventually they're going to move down here full time. It's a good question to ask, and it may give you some more opportunity to earn commissions. There's 5 basic rules in a 1031. The net selling rule, which we'll go over, the like-kind investment rule, meaning like-kind property. You have to use a qualified intermediary like Midland to set up a 1031, and then the timeline rules, which again, we'll go over in further detail. The first rule is called the net selling price rule, and that's how much you have to spend in order to pay no taxes. So if a person is selling for $200,000, they have closing costs, and you can see that not all closing costs are considered coming off the top of a selling price and giving you credit towards the exchange. So in this case, it's like commissions and some of the title costs, things like HOA fees, utilities, taxes, rents, deposits, anything like that that would appear typically on a closing statement are not considered exchange expenses, so they cannot be subtracted from the sales price to arrive at the price that you have to put in the new property. So basically what this slide is saying is, if you have a net selling price of $170,000, you need to buy something that's at least $170,000 or more in order to fully defer your taxes. Like kind, really in this case, it just means it has to be real property. It does have to be deeded property. So for instance, a mobile home, if it is not a home that's deeded as opposed to stickered, then that is personal property, not real property. It does have to be used for investment or for their business. Things like primary homes, secondary homes, vacation homes, if they have too much use of it, do not qualify for a 1031. Literally, things like condos that are rented the majority of the time, an office building that they use for their business and maybe rent out the rest of it. Those are the kind of things that qualify for a 1031. A piece of land that they're holding for investment purposes and then selling at an appreciated value would also qualify.
Ask a question.
Sure.
With that second rule, it being a like-minded property. So what about these Airbnbs? How would those fall into play?
So those would work as vacation. They just have to follow the vacation rules on Airbnbs. So they'd sell whatever property they have. They'd buy, say, a rental condo or a house that they plan to use in Airbnb. They can only just have limited use of that. So as long as they're renting it out on a regular basis, they're not using it more than the vacation rules allow. And just so you know what those vacation rules are, they can use it the greater of 14 days a year if they rent it 14 days a year, or 10% of the amount of time that it's rented. So hopefully that makes sense. So very limited use on their part. That's why things like a second home doesn't qualify, because if you think about, there's only 365 days in the year. So if they rented it 300 days a year, the most they could use it is 30. Does
Wow.
that kind of help on that?
Yeah.
So
Yeah, that kinda helps.
limited use. So
So
they
do you-
really have, go ahead. Yeah,
The profit margin doesn't make any difference on that? You're just looking at the property itself.
just the property as well and the use of that and
Okay.
how they report it on their income tax. It's a good
Alright.
question.
Alright.
Here's some examples of things that qualify. You can see it's pretty varied. See how down here, I even mentioned this, parking lots and trailer parks. But you have to be very careful about mobile home parks, trailer parks, on what actually is considered real property. Often the land itself is, but maybe not what's parked on it. But there are mobile home parks, as we know, that the properties are adhered to the land and they are deeded. So that whole property itself would qualify versus just the land. But you have a lot of options here of what's considered real property. Here's the things that do not qualify. One thing I didn't mention is flips or spec homes. So if someone's in the business of developing homes and then selling them, so basically creating inventory and selling, those properties do not qualify for 1031 exchange. If you have a client that likes to fix and flip, those properties do not qualify. So the way the IRS looks at it, they're looking for someone that's really purchased something for a long-term hold, either to generate income or to appreciate. So if somebody's just buying it, fixing it, flipping it, that is not considered an investment property. And if they were audited, their exchange would be disqualified. Qualified intermediary. So that's something that Midland does. It has to be a third party that helps facilitate the exchange and helps the person doing the exchange follow the rules and the timelines. There's certain people that cannot be a qualified intermediary. Most people go out to a third party company like Midland, but people like attorneys and CPAs may also provide that service, but they cannot have any prior relationship to the person. So it can't be your attorney. You as their real estate agent can't be their qualified intermediary because you are working with them directly. So their attorney can't, their CPA, if they're working with them every year, cannot be their qualified intermediary. And here's some examples. You can't be your own qualified intermediary, surprise, surprise. It can't be like one of your employees, and it can't be someone that you're closely related to. All right, the timelines. So the entire timeline of a 1031 exchange begins on the closing date of the property they're selling. You have 180 days from the day they close on the property they're selling to actually close on the new purchase. On the 45th day within that timeline is when the exchanger has to identify a property or properties they want to buy. They do not have to be under contract, but they do have to have their plan by the 45th day. So that's a very short period of time, especially in our market right now. You have 45 days from closing to know what you're going to buy. So sometimes it's a good idea for them to already be under contract for the property they want to buy, maybe contingent on the property they're selling, or maybe they've put a large deposit down on that replacement property so that the seller will hold it until they're actually able to close on the property that they're selling. So here's what that looks like. Day 45 is the most stressful day of the exchange for sure. We do provide a form for them. So basically they list the address, city, state, the value of the property, meaning the sales price or the list price, and then they sign off on it. And we do have to receive it by the 45th day or else their exchange is over. Holding title. So that is another rule. The way they hold title on the property they're selling is the way they need to close on all their purchases. And to be more specific, what we're talking about is who is the taxpayer. So if Janet Davis owns the property I'm selling, then I need to buy the new property as Janet Davis. However, what if I decided to set up a disregarded entity like an LLC, and we see a lot of those in Florida? My accountant really just passes through any of my expenses and income through that LLC personally back to me, then that may also be the same taxpayer. So if somebody comes to me and says, Janet, I'm selling as Mr. Joe Exotic, I'm going to buy as Joe Exotic LLC, I do say, hey, is that the same taxpayer as yourself? Have you consulted with your tax advisor to make sure that the IRS would view those two entities, yourself and your LLC, as the same taxpayer? In a lot of cases, that is fine. Just FYI on that. The exchange does have to be set up before you close. So after you close, it's too late. So before they close on the property, they have to set up the 1031 exchange. It's great if we all have at least 2 weeks notice to get that set up. Sometimes they're not sure, they're waiting for a couple of contingencies to clear from the buyer side. So maybe it's a week before, but we do have to work closely with whoever's doing the closing. So for instance, JK, if I'm working with them, they like to know in advance because some of their paperwork has to be altered if it's a 1031 versus a regular closing. One of the documents that's used is the closing statement, and it has to show that it's a 1031 exchange and that the client is not receiving any funds personally, that they're going into the 1031 exchange. There are other types of exchanges, which I mentioned. One is called the reverse exchange. So instead of selling your property first, you're going to buy the property first and then sell your property within 180 days. This works well, again, in markets like what we have, because right now it's hard to find replacement properties, but your client's got to have funds or access to a loan. There's specific rules that have to be followed to do a reverse exchange. They're a lot more complicated. Basically, the person that's purchasing the property cannot own the property until they sell their property. So they have to use someone like Midland to be the title holder. Here's some of the reasons that people are doing reverses right now, and we do have more than we usually have just because of the way the market's driven. The seller of the replacement's forcing them to go ahead and close, and some of these people may be able to close 2 weeks later on their relinquished property, but they may have to buy the replacement property first. Funding, cash or a loan. The trick is if it's cash, there's usually no problem. If they have extra money right now, and then we can pay them back after they sell their relinquished the property that they're selling. But if they do have to have a loan, the bank has to put the loan in the entity that we established to take title of the property, which is a LLC, a single member LLC, and the client is not a member of that LLC. They're an agent of that LLC. So a lot of banks don't like that. So sometimes these don't work for clients depending on who's doing their financing. But we do talk to the lenders and try to make it work if at all possible. The timeline in a reverse exchange is exactly the same as the timeline on the regular exchange. It's 180 days, you're just moving backwards. You buy the replacement property, 45th day, you identify what you're going to sell, and then you close on the property that you're going to sell on or before the 180th day. We then transfer funds to the client to pay them back basically for the replacement property if they use cash, or if a lender is involved, then we pay the lender back directly with whatever cash we get. And then we assign the interest of that title holder to the client that did the exchange, and then they own that replacement property. Crazy, right? The other type of exchange is an improvement exchange, and this works well if somebody is buying something of lesser value and needs to include improvements to actually defer their capital gains. So for instance, if they sold a property for $200,000 and they can only find a property for $150,000, they may be able to include $50,000 of improvements in the 1031 if it's set up appropriately, and then they can still defer their gains, because at the end of the day, the property they end up with is worth $200,000. There's different contractual language that is required for a 1031 exchange. We live in Florida, so we're lucky. All of our standard Florida contracts already have the 1031 language included in there, or if you're using a commercial contract, you can select a section to add to your contract that talks about a 1031 exchange. If not, you all are going to have access to this language that can be added just in case you have a special type of contract that's not a standard one. Same thing for the replacement property. We do ask that there's language about the 1031 in there. As I mentioned before, we have lots of resources. You can go to our website. On there, you can download different guidebooks that you can send to your clients. You can direct your clients there. We will do video calls or phone calls with your clients, Zoom calls, anything like that. Let's see, you can call, text, or email us and let us know if you have questions, like I mentioned before. So we want to make it easy for you. We just want to be your resource. And we aren't competitors. We don't sell any real estate. We do have really strong people in our departments that can help your clients. We have 2 certified exchange specialists, which is a unique designation for 1031 specialists. So we have a lot of knowledge on our staff that know how to structure these 1031s, and hopefully they would all hold up if your client was audited. And there you go. There's our last slide on Midland, and obviously people make us. So we wouldn't be here if it wasn't for our people. All right. Does anyone have any questions?
Yeah, I have a question. So I'm actually helping a buyer who's currently trying to sell. They're actually trying to sell 2 properties, a real property and I guess a business property up in New Jersey. Now, can they do this work that they can sell 2 properties to come and buy a single property down here in Florida?
Yes. Yeah, so they can definitely sell. You can have multiple properties on either side. I know I'm still sharing my my thing here. Let's see if I can get out. I can't, so I'll just keep going. So sorry, you have to keep looking at my screen. So they can sell like multiple properties on the front end, combine those funds and buy a new property, but they do have to follow the timeline of the first property that sells. So if they sell like a month apart, they have to get all those sales in and then buy their replacement property by the timeline of the first one. So the 180th day of the first one. Does that make sense?
Yeah, that makes sense. Now, let me ask you this. So when it comes to the 1031 exchange, is this something that they should already, I guess, speak to you and kind of like establish that account with you before we go into contract? Or is this something that after we go into contract and we start talking to the title company, then we get you involved?
That's when you want to get us involved.
Okay.
So unless they have questions before, just to make sure they understand, you don't really have to get in touch with us until you have a fully executed contract and the title company established.
Gotcha.
Good questions.
And it can be from
Janet,
state
we
to
have
state.
another, sorry, Rodney. We have another, oh, you can go ahead. There's another question on the chat too, so you can check that one.
Okay. Go ahead, Ronnie. What'd you say?
I was just asking, just same thing for like Jonathan's example. So if they were selling in New York, you can just make that exchange down here in Florida.
Yes, and oh, so let me clarify. So we can do exchanges throughout the whole United States. So it doesn't matter where they want to sell. And I didn't bring it up because it kind of opens up other questions typically, but
Mhm.
someone can do a 1031 in the United States for any state. So sell anywhere in the United States, buy in the United States.
Okay.
If they wanted to buy foreign property, then they have to exchange foreign property for foreign property.
Okay. So they can have like something outside of the country going, bringing it into making the purchase here. They wouldn't be able to do that.
So they can't do outside the country. They have to find something outside the country.
Okay.
So
But
it's
they
got to
still
be
can do one
foreign
though.
for foreign. They can
Foreign
do
for
one,
foreign.
yes.
Okay.
Typically foreign exchanges, there are some, I mean, we've done them before, but typically it makes more sense for them to do it in the country where they're selling because of the currency and the cost it would cost them to have money come to the US and then back out to Italy or wherever.
Mm.
So most of the time they're going to use an attorney where they are selling. It makes the most sense. See, if the buyer's selling a property for $375 and wants to purchase a property in Florida, does the property have to be at least $375? What if it's less? Okay, that's a good question. So they can do a partial 1031. So if they sell for $375 and they only want to invest $300,000 or that's all they can find, then they're going to owe capital gains on the $75,000 that they do not reinvest. That's perfectly okay. If we see that that's what they're doing, we'll bring it up to them. If they know off the top of the, get-go that that's what they're going to do, then we usually say, go ahead, talk to your tax advisor on what your tax consequences are going to be. But you can still do it. Good question.
Anyone else? No more questions? I guess.
All right.
No.
Yeah, hopefully I didn't go too fast, but my phone number is on there. JK has my phone number and my email. If you guys need anything, feel free to reach out. Any specific questions or just general ones that you might have, I'm happy to help. Oh, what if
Okay.
it's over? Oh, whoa, I see a sneaky one that just came up over there. If it's over, they're just going to put in their own funds. If it's over, that's good. So they have a good exchange. If they're selling for $375 and buying for $400,000, that's great. They've covered their exchange, and then they just have to come up with the way to pay the difference.
Okay, I'm sorry. I do get another question. So
Okay.
when it comes to contract, typical, does it have to be? Can it still be a 30-day contract? Does it have to be a little bit longer since it's different process?
You mean like to close? Like
Correct. Yes.
no, it can be 30 days. So once we have their fund, so on the front end, you do a 30-day contract, say it's a cash buyer, we can set up the exchange right away. Then once we have that person's funds, they only need to sit in the bank overnight. And then we're able to disperse those for any purchases. So you could have them happen, within a couple of days of each other.
Okay, great.
The good thing about that is then they don't have to sweat out that 45-day thing. So if they close one after the other, then they don't have to identify on the 45th day because they're done.
Okay, thanks.
Mm-hmm.
Sorry, I actually have a question too. One more. So with the timeline itself, right? Because I know you have to identify a property within 45 days, but let's just say something happens to the property itself, like a hurricane or something like that. Would my timeline start over again, or would I be limited to the previous contract going into my second contract?
All right, so that's a good question. Interesting, use the words hurricane. So let's pretend there's not a hurricane. So the 45th day is a hard date that is set by the IRS as one of the rules that has to be followed. Once you identify on the 45th day, you can't change your identification. You have to be able to purchase what is on your list of the 45th day, no changes. However, there are cases that if there's a nationally declared disaster, such as a hurricane, in a specific area, and it has to be declared federally, then there are times when the 45 days might be extended or the 180 days might be extended. So let me give you an example that happened last year for COVID. Remember how tax returns were extended, but it was something weird, kind of like July, end of July. I think people could file tax returns. Well, that's what they did for 1031s too. Anyone that was already doing an exchange, and depending on where they were in the exchange, could either extend their 45th day or their 180th day to July 31st. So those are rare. I would never go into an exchange thinking that anything like that's going to happen or occur. They rarely do. I mean, that's probably the first real extension I've actually had. Obviously, there were some disasters this year where people could have been affected, like in Mississippi and Louisiana. I didn't have anyone affected in those states where I was doing exchanges, but it would be up to the client and their CPA to make sure that they qualify for that, because there are certain rules. All right, here's another question. Can you split a higher value commercial property into two or more equal or greater than value, or only one for one? Okay, so yes, so you can take a high value commercial property or any property, big giant rental house, you know, where everyone's giant families comes and vacations, right? Sells for a couple of $1 million, and you can sell that and buy several rental condos or several commercial properties. Or you can sell them and buy ones of greater value too. Your goal is to buy something of equal or greater value than the net selling price, or the selling price, however you want to look at that, net selling price. So once you go above that, then that's good. You go below it a little bit, there might be a tax obligation. But multiple properties are possible. Selling multiple properties and buying multiple properties are fine, but you have to follow the same timeline. So that 180 days is the timeline that has to be followed.
And it would be best, Janet, to try to bundle them, right? In that case, the sales.
Like if you were going to buy more than one, you mean?
Yeah, and sell. More than
Well, the thing about bundling things is that, you know, that's kind of a gray area. So each property itself is typically an exchange in itself. So I think it's more about timing versus bundling, but we do have a lot of bundling going on right now. And there's a couple of issues with that. One, you're setting up one exchange to sell two properties, but they're going to the same buyer, same closing date. They're possibly on the same contract, but most of the time people want two deeds, right? Two closing statements. So it may cause confusion if there is an audit, but yes, we're setting them up for bundling. So what I would suggest is just planning more than bundling, unless you really do have one buyer that's buying maybe somebody, you know, 3 properties from someone on the same day, and you can list them all on the same contract. I mean, that'd be pretty legitimate. Or maybe you have 3 contracts, but they're each contingent on the buyer buying all 3 of them, or else it's a no-go. Hopefully that makes sense.
Yeah, thank you.
You're welcome. All right, that might be it.
Thank you so much, Janet. We appreciate your time. Great class. And, you know, if no one has more questions, then we'll say goodbye to Janet. So thank you so much. Guys, remember we have the grand opening of the book office tomorrow. So we hope to get to see you there, okay? The ribbon cutting will be at 5 p.m.
Okay.
The Boca Chamber will be doing it. So we hope to see you guys there. All right. Thank you so much, Jen, and I appreciate your time. And we'll be sending over the recording to Max, so he will be sharing with all of you.
Thank you so much.
Thank you. Take care.
Bye.
Bye-bye.